As we have discussed in the last video, capital budgeting is the process of evaluating long-term investments. Think of it as a roadmap that helps companies choose the best projects to invest in, the ones that add the most value. In this video, we will be understanding the techniques of capital budgeting and methods of calculation. The major techniques used to evaluate a decision using capital budgeting are Payback Period, NPV, that is net present value, IRR, that is internal rate of return, Profitability Index, PI, accounting rate of return, ARR. These techniques help in determining whether a project is financially viable and should be pursued. Let's understand these techniques in depth and how to calculate the project feasibility under each technique. First up, the payback period. It tells you how long it takes to recover your investment. It calculates the time needed to recover your originally invested amount. The formula to calculate payback period is initial invested amount divided by cash flow per year. For example, if you invest $1 lakh and earn $25,000 per year, it'll take 4 years to break even. Only drawback of payback period is it ignores cash flows after the payback and the time value of money. The net present value, NPV, is a method that is primarily used for financial analysis in determining the feasibility of investment in a project or a business. It is the present value of future cash flows compared with the initial investments. It tells you how much value a project adds in today's money. The formula used to calculate NPV is given as present value of a future net cash flow, RT. A time t is calculated by dividing that cash flow by 1 plus I raised to the power t, where I is the discount rate and t is the time period. This process discounts future cash flows back to their value in today's terms, reflecting the principle that money today is worth more than the same amount in the future due to its potential earning capacity. Let us say Chococrunch Incorporation wants to expand its business and so it is willing to invest 10 lakhs rupees. The investment is said to bring an inflow of Rs. 1 lakh in first year, 2 lakhs 50,000 in the second year, 3 lakhs 50,000 in third year, 2 lakhs 65,000 in fourth year and 4 lakhs 15,000 in fifth year, assuming the discount rate to be 9%. Let us calculate NPV using the formula. Just in case you are wondering how we have arrived at the present values, the calculation for each year is displayed on your screen. In order to arrive at the NPV, we will add present values of the inflows from all years and subtract from the initial investment. In our example, we have got a positive NPV, which means the project generates returns exceeding the 9% discount rate, indicating profitability, and we must accept the investment as it adds value to the firm. Net present value, NPV, is one of the most reliable methods for evaluating investment decisions. Here's the key takeaway. If NPV is greater than 0, the investment is profitable. It adds value to the business and exceeds the required return. If NPV is less than 0, the investment is not profitable. It destroys value and should be rejected. If NPV is equal to 0, the investment breaks even. It neither gains nor loses value, and the decision may depend on strategic or non-financial factors. Profitability Index, or PI, tells us how much value you get for every dollar invested. It's the ratio of the present value of cash inflows to the initial investment. The formula used to calculate Profitability Index is present value of future cash inflows divided by initial investment. Suppose a project requires an initial investment of $8,000. It generates cash inflows of $3,000 per year for 3 years. We'll use a discount rate of 10%. Now, let's calculate the present value of each year's inflow. Year 1, 3,000 divided by 1 plus 0.10 raised to the power of 1. That equals $2,727.27. Similarly, we will calculate for rest 2 years and add them to arrive at present value of inflows. Now, we calculate the profitability index, a sum of all the present values of inflows divided by initial investment. That gives us PI of 0.93. Since the PI is less than 1, It means the present value of returns is less than the investment. This project destroys value and would not be recommended. Remember, a profitability index greater than 1 indicates value creation, while less than 1 signals a loss. Internal rate of return, IRR, is the discount rate that makes the net present value, NPV, equal to 0. It tells you the expected rate of return from a project. You may wonder, what is a discount rate? The discount rate is the rate of return used to convert future cash flows into present value. It reflects the time value of money, risk of the project, and opportunity cost of capital. It answers the question, how much is a future dollar worth today? Let's consider a short example to calculate IRR. The present value of future inflows is $3,000 and $2,500 for year 1 and 2. You're trying to find the rate that makes NPV is equal to 0, which is exactly what IRR is. The present value of $3,000 received in year 1 plus $2,500 received in year 2, discounted at rate, should equal the initial investment of $5,000. You can use Excel, trial and error method, or financial calculator to calculate IRR. We have got 14.5%. This means the IRR is 14.5% if your required return is 10%. You accept the project because IRR is higher than 10%. Accounting rate of return is the average annual accounting profit from a project divided by the initial investment or average investment. It helps you understand how much accounting profit a project is expected to generate each year as a percentage of the investment. Let's look at the formula for accounting rate of return. ARR equals to average annual profit divided by the amount invested multiplied by 100. This gives you the percentage return you're earning on your investment each year based on accounting profits, not cash flows. Let's calculate the accounting rate of return or ARR using a simple example. The initial investment is $10,000. The average annual accounting profit is $2,000. Now, let's apply the formula. ARR equals to 2,000 divided by 10,000, then multiplied by 100. That gives us ARR equals to 20%. So, this project earns a 20% return each year based on accounting profit. Let's say if the target return is 15%, this project is acceptable because ARR is 20%. Capital budgeting techniques like NPV, IRR, Profitability Index, Payback, and ARR help businesses make smarter investment decisions. Each method offers a unique perspective, so using them together gives a clearer picture of a project's true value. If you found this helpful, don't forget to like, share, and subscribe for more videos on finance concepts.